You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to Wealth Formula Podcast. Of course, this is the Wednesday edition with me, Buck Joffrey, and Zulfe Ali of Velerity Group. Zulfe, welcome back to the program.
Good to be back, Buck. How you doing?
Good. And I know in a little bit we're going to add a couple of guys that you work with to add a little bit more content that people might have some interest in. But let's start with our usual rundown. I mean, the show that we did this week with Bronson, you know Bronson actually, and he's so this was, I think it was mostly there's sort of more of a mindset kind of show. You know, I call it sort of the wealth thermostat. That's what I've always kind of thought about it for me personally, that there probably is some ingredients that go towards the mindset of the wealthy versus those who are not as financially successful. Do you have any takes on that? Obviously it's not like a, analytical or whatever type thing, but just you've been around a lot of really wealthy people. I mean, obviously having spent time, in on Wall Street and then running a sovereign wealth fund with a whole lot of probably some of the wealthiest people in the world. So kind of curious on your thoughts on them.
I largely agree. I mean, I think the more you network with and hang around people that are extremely successful, you pick up their habits, you pick up their approach on how to work, with other people, on how are they prioritizing things in their life that's making things work. So I don't disagree. I guess the question I have is, there's also good examples of people that may hang out with very successsul folks and stuff, but just aren't able to succeed themselves, despite the fact that they've surrounded themselves. They have all the belief in the world that they deserve to be high earners and all that stuff, but they just can't seem to get that lucky break or whatever. So the question is, what are they not doing right? I'd be interested if Bronson had kind of thought through that kind of piece of it as well.
Well, when you have these kinds of conversations, these kinds of books and things like that, you generally highlight the success stories, but there's a lot of failures that go along with them as well, right? To the extent that I think what he was trying to get at is sort of, if you could, try to get a few common denominators with people. I think probably the biggest one that, in my opinion, that it probably was most seems to capture at least self-made entrepreneurs, right? I mean, you're around a lot of oil money that those guys were, those guys didn't create their own wealth, right? But
inherited, yeah.
Inherited wealth is a very different thing, but entrepreneurial wealth, there is a common denominator there of people who are willing to take some more risks, probably put more on the line. There is probably something similar to a risk, thrill-seeking gene there. Although for me personally, I've never been one who would ever want to jump out of any kind of, moving aircraft or anything like that. But there is sort of, on the business side, there is an element of that. And pretty much everybody I know who has made it, really big, successfully, financially, has had that. Now, that being said, it's not a big surprise, right? Because how else would you possibly get there unless you've actually made a move, right? Like, it's just not going to, no one's going to come and knock on your door and, offer you an opportunity to be independently wealthy and hand you a business on a plate. It just doesn't happen that way. So I think there is that. And, it certainly doesn't hurt to have these kinds of thinking type shows. And I actually sometimes think it's just nice to think about your own situation and say, okay, where do I want to be in life? Where do I think I should be in life? And then what's the trajectory that I actually am on? Because often that will tell you whether or not you're headed in the right direction, right? Like if you're like, one goal in life is to be ultra wealthy and you're making your $100,000 a year and you're not really doing anything different on a day-to-day basis, well, it ain't going to happen. Yeah. It just ain't going to happen, right? It's not rocket science. It's just like, you've got to figure out what puts you in the position for what it is what you want to do. But anyway, let's.
I think there's a lot to do with tenacity too.
Right.
That it's not just that you're going to be gliding towards your goals. It's that you've got some jet propulsion towards those goals, right? Nothing is going to shake you from achieving what you want to achieve. And I think it's having that real focus and drive to get it and take it for yourself, as opposed to wait around for someone else to deliver it to you.
And there's also failure issues too, right? I mean, it's so cliche to talk about people who can deal with failure and rebound and stuff like that. But in the entrepreneurial game, my gosh, I mean, it is crazy. Like, you've been around me. I mean, it's just like one day, like I'm the king of the world. And the next day it's just like, Jesus, what is happening? And it's just, you have to have the makeup for that and be willing to deal with it. And then anyway, that's a lot of it as well. Let's talk a little bit about what's going on in the world. It's been a crazy week. I don't think we talked last week, but I mean, we haven't really talked since the assassination attempt. And I mean, okay. This is what I got to say here about that. Okay. Is okay. This is not a political show. And say what you will, you love Donald Trump, you hate Donald Trump, whatever, but that is one tough SOB, man. He gets up after getting shot and raises that flag. I mean, that is crazy. The
instinct that's the first thing you need to do when you don't even know if the gunman's been taken out or if there's someone else holding something. I mean, it's like I'd be under several layers.
I know
of guards. The
Secret Service. I don't even understand how they let him do that, right? Like how they know there's not like 2 or 3 other gunmen out there, right? But he gets up and at that moment, the photos, it looked like Iwo Jima, right? Like the photos of Iwo Jima. And meanwhile, the contrast and just the pure optics of poor, Joe Biden sitting with COVID at home, it was like game over. It was over. Yeah. So I'm not surprised Biden stepped down.
If it wasn't already, that was the nail in the proverbial coffin.
Yeah.
Sure. But a lot has happened, on the political front, obviously, with even the latest, news of Biden dropping out of the race, Harris pretty much gliding into that next position there. There has been a lot of political, volatility going on. I'd say the market hasn't reacted tremendously to it, so that's kind of interesting. It seems to continue to plow ahead, really focused on the economic drivers. So, again, I think most of what I'm hearing the market being focused on is rates. So we spoke a couple of weeks ago now, and economic data had just come in, and the Fed had just, made some comments that they're getting closer to, the Fed's getting closer to cutting rates. And since then, the markets, have been pretty favorable, reacting on the continuous uptrends. So we've seen the equity markets continue to go up. S&P has been a little bit choppy just because there's been some rotation out of some of these very large cap names, and that's something we talked about too a couple weeks ago and before that, which is there's been such a focus and concentration on a very select few names in terms of what's driving the equity markets up. And what you saw over the last couple of weeks was actually very different, where those same kind of very favored names have, people are taking profits in those. But then you look at a much broader index of smaller companies like the Russell 2000, spiking up like 5% in a week's worth of time. So it's up, kind of 11-12% now year to date. So you've seen, that equity, that conviction in equities just kind of rotate from one type of equity to another. So, broadening it out, which is actually a more favorable, kind of a bull market that you want to be in, where you have a broader participation of companies, not just a few companies doing that. So it could be, it could be a sign that we're going to see continued rotation and a broadening of that, a broadening of the companies that are doing well. So that's been positive.
So going back to the rate cuts, so can you talk a little bit more about that? I mean, so he was suggesting possibly in September. That seems extremely unlikely to me, given the election in October.
So Chairman Powell is not doing anything on timing. So I think he's not gonna say when that's gonna start. But what he did signal was that and he hasn't done this before, but that the risks are not only on the inflation side, but now he's saying there's equal amount of risk that having higher rates could actually dampen the economy more than that they're trying to do. So so there's a balance now that he has to work with. So it's not just too higher rates, not just trying to keep the rates high, but the risk of keeping them high too long. So so I think what he's done is he's kind of set the framework for a cut in the future, right? Sometime later in the year. He's not projecting when. It's still saying data driven. The market, interestingly, a lot of the market is projecting a rate cut in September, which is coming up soon. There's always the question of whether the Fed wants to be ahead of the election in its rate cut actions. My own personal view is that it probably comes in November, just after the elections. But we'll have to see. I think either way, though, it's clear that labor markets have been softening, and we've seen inflation coming down, and will likely continue to decelerate. And you've got the makings for a change in the Fed's cycle to more of a cutting cycle in the future.
So
it'll kick in some point later this year.
As it relates more to sort of this audience in real estate, obviously we look at 10-year treasuries and that sort of thing. So what's going on over there?
Yeah, treasuries, 10-year bonds came down. We started at about 4.5% yields on 10 years at the beginning of July. They're down about 4.25%. So that's pretty meaningful. 0.25% is actually pretty meaningful on a 10-year bond. Residential rates are still relatively high, so they're still kind of mid to high 6% range. And of course, SOFR hasn't moved at all, just because SOFR is pretty consistent with the Fed rate, so it's right at 5.3%. But what you see though is when you have the 10-year coming down, the ability and the 5-year as well, by the way, also coming down from about 4.4% down to about 4.1% now. But what that means is that you have the ability to swap from that floating SOFR to a fixed rate at a more attractive rate, because you're effectively, the swap rates are going to be predicated on the treasury rates. So you can, there should be an opportunity for, investors or acquirers of real estate assets to lock in more favorable fixed rates for kind of that 5-year tenor, which is a good sweet spot.
And again, just to emphasize, and I think this is really important. Again, I think we're in this period of time where we have, still high interest rates. We're looking at, an environment coming up where interest rates are almost certainly going to come down. I mean, they've been forecasted to come down. We know that there's enough pressures out there. We've talked a lot about some of the data that's out there with lagging indicators and that kind of thing in the past. So if you can find real estate right now that's a good deal at a high rate that continues to cash flow, now's the time to really look into buying it, because, again, it's basics, right? Like when those interest rates start coming down, asset prices go up. So if you're buying something that cash flows and is doing reasonably well in a high rate environment, and you're going into a descending rate environment, those asset values should rise. So just keep that in mind. And I'll bring that up in part because I know through our investor club, we've had some distressed stuff that looks good, and we have some stuff coming up very soon. If you have not signed up for our accredited investor club and you are accredited, make sure you do that as soon as possible. Go to wealthformula.com and get onboarded. You'll need to get onboarded with Zulfe as well through Velerity. Okay, so Zulfe, I know you you've brought a couple of guests along with us today from your group there at Velerity. You want to introduce Ryan and John here?
Yeah, absolutely. Ryan and Jonathan are both partners that work with me through Velerity Wealth. Ryan actually is with Velerity Wealth. He wears a couple different hats, but Jonathan is a managing partner at Unbridled Wealth, and they're an important partner of Velerity Wealth. And we'll get into some of the details there. But the context here, Buck, is that we usually kind of reserve this last section to talk about different products and educate the market. And I thought, well, in the past we've spoken high level about Velerity Wealth and the fact that it is it's effectively a family office to our clients, meaning that we provide comprehensive financial advisory services. That means financial planning, where we've got in-house certified financial planner, that's Ryan. Investment management, so we've got in-house, former sovereign wealth chief investment advisor, that's me. We've got tax strategy and asset protection. Again, we have an in-house professional that does that. He's not with us today, but we've got in-house capabilities there. And then we also have risk management capabilities from in-house. And that includes on the insurance side. Again, Ryan is insured there, has his license there on the insurance side, and Unbridled Wealth is an important partner for us on some of those products. So what I wanted to do is drill down maybe into a specific area, so listeners get a sense of how we deliver our services when we talk about being a comprehensive financial advisor, and we can focus on risk management. Which is a very broad discipline, but it needs to be implemented, in all aspects of financial advice. So that's why I brought both Ryan and Jonathan to kind of talk about some very specific solutions that we provide from our side.
Great. So, yeah. So I mean, obviously we have this idea of what a lot of ultra wealthy families do. We've talked about, sort of mindsets and that kind of thing, but family offices in general, you hear about this terminology, family office. What does that even mean? And, how does that, how does Velerity reflect those values for people who are, maybe not at that level of wealth? What is a family office?
Yeah. So typically a family office is set up in a way that a family, which is, well endowed with some wealth, has the resources to bring all the various aspects of wealth management together. So they'll have their own investment manager, they'll have their own financial planner, they've got their own tax guys, they've got their own insurance. So they bring everything in-house, and they are effectively professionalizing that investment and financial management activity by themselves. Now, that gets expensive, right? To hire a CIO, to hire a financial team, to get some analysts on board, tax guy, all that becomes very expensive. So what certain families have done is they've come together and formed multifamily offices, so multiple families together, utilizing that same infrastructure. So that's one way of doing it. Alternatively, what we've done at Velerity Wealth is we've put together all that infrastructure and all that talent, and we can offer that comprehensive solution to individuals that may not be able to, quite afford hiring their own team to manage their own professional. So that's the way to kind of think about what we're bringing is all that benefit of having professional management, advice, all of that, and to do it in one place. So you don't have to go to four different professionals, five different professionals to get, different views and that sort of thing.
Well, and it's also, I mean, I think the thing that I think about is one of the things that I've noticed over the years as my own financial situation has gotten more complex is it's really hard to keep track of stuff. I mean, it is extraordinarily difficult. I mean, just a pure number of investments and how are they, how are they performing? How are you balanced? Are you, do you have some sort of risk that you're unaware of, that you're not covered for? Whether it comes from insurance, are you adequately protecting your family in case something happens to you? So all of these things, like you can, what happens as you continue to, create more and more wealth for yourself is the personal finance becomes increasingly complicated to the point where it starts requiring almost like a business structure in and of itself, right? Yeah. And most people can't afford necessarily to hire that entire staff. So I think what you're saying is Velerity is there to sort of be a transition. I mean, you to go from handling this all on your own to basically having, this group of people that you can say, okay, you and I are on the same page in terms of philosophy. Here's my philosophy. I'm into alternative assets. I want to have exposure to other stuff, but I want to make sure you understand what my philosophy is. Now let's go execute it. And is that, Ryan, is that, we'll get you to talk here a little bit. What's your take on that?
Yeah, I think that's a great way to frame it. And I think what a lot of people kind of make the mistake of doing is assuming that a financial planner is synonymous with an investment advisor. And that is certainly investment advice is a very important, I would say even central part of comprehensive planning, but there's a lot more, like you just talked about, beyond that. And I think the real secret sauce, if you will, is integrating all of that into a comprehensive plan and creative strategy. And then there's these different subsets that we talked about: risk management, insurance, investment management, et cetera. And so I think the ability to have all of those under one roof, so to speak, even though there's different companies, is really helpful, because some people may not realize that what might be good in one area is kind of counterproductive in another. And so you need that top-down approach, but you also need someone who can really get into the granular details.
And what's interesting with you, Ryan, and I think this is a kind of probably important for people to understand, is you're also philosophically, as I understand it, you were a Wealth Formula listener before we actually met. And so I bring that up because, it has been, for many years, I've been sort of against this idea of having sort of more of an organized kind of situation until I realized I needed it myself, sort of, right? How do you take this idea of personal finance and alts and all that and integrate it with this concept of having this kind of planning?
Yeah, I think you just hit the nail on the head, Buck, is that for Jonathan and I and everybody we work with, we are investors, policyholders, clients, practitioners first and foremost, and that's absolutely critical. It's one thing to have the education, the credentials, the initials after your name, but when you're actually doing it for yourself, you know that A, you believe in it, you're putting your own hard-earned skin in the game, and B, you are going to understand it at a deeper level. So that's a really important starting point I usually hit at the very beginning with all my clients, whether that's on the insurance side with Unbridled Wealth and or the financial planning and investment advisory side with Velerity. But knowing that we are in the same boat, we're doing the same things, we're eating our own cooking, so to speak, right? And so through that, I have noticed that it was really a godsend to connect with Zulfe, because I had been listening to your podcast for years. Some of my clients are part of your network at Wealth Formula, but when we connected, and it's very tough in the regulated securities licensed space, there's a lot of regulation and compliance, and it's not super entrepreneurial or outside the box friendly, which a lot of us are. So being able to connect with somebody who has that philosophy, that's a really important point that we try to hit on the first part, is that a financial planner is not just a glorified stock, bond, and mutual fund manager, right? There's a lot more that goes into it. There's alternatives, there's real estate, there's alternative strategies like cash value life insurance, et cetera. So I think, again, that's where you kind of get more of that family office approach that typically have a lot more allocation to alternatives and more creative strategies that are outside the box. And so that's definitely, I think, a really important starting point that I think your listeners in particular, your network, since I am part of that myself, is really hard to find in the quote unquote traditional financial planning and investment advisory space.
Just tell us kind of what the process is. Okay, so now say somebody reaches out to you guys and says, hey, I'm a physician and I make, $800,000 a year and I've got this financial advisor, but it doesn't seem like anything's happening with my portfolio. What's the first step? I mean, what is this what's the intake process or onboarding process? And like, what are some of the things that you would go through to sort of, make sure somebody's buttoned up?
Yeah, I mean, the very first part is just getting our arms around their personal financial circumstances. So we call that a financial review, just data collection and intake, which is very front loaded. That's a big part, especially when you start to get to where you talked about, Buck, where you've got a lot of things where it's becoming hard for, somebody to individually manage themselves. So, there's any number of ways this can work, but in an ideal scenario, we start off just by collecting that information, doing that financial review, doing the risk profiling, and doing ideally a fee-only planning-based project, kind of just like a consulting arrangement almost at the beginning. And we refer to that as quote-unquote phase one. So we're not trying to sell products. We're not trying to manage assets or make any specific recommendations. We're just getting the information, which is a really important thing because there's enough uncertainty as it is. You want to know as much as possible the full picture of everything. And I'm a stickler for details. And, I think I've appreciated the fact that people who have come to us from you so far have been willing and able to provide us all that information. So that's really the first step, is just understanding the breadth and scope of their entire financial and personal circumstances too, right? On a qualitative level, personally, their desires, their dreams, their goals, their timelines, et cetera, right? And then from that end of phase one financial planning engagement, we have what we call phase two, which is now we've given you a comprehensive plan. We've given you certain recommendations. If you would like us to implement those recommendations through the sale of products like insurance or, the management of assets directly, then we can do that. Or we can just do kind of an ongoing subscription where maybe we're not managing assets or selling products, but it's just kind of like, the right word to use in the securities industry is a subscription model, but what a lot of people would refer to this in other contexts would be like a retainer.
Right. Just sort of a consulting model, right?
Exactly. Right.
Yeah. Jonathan, I want to get you involved with this. You want to talk a little bit about who is Unbridled Wealth and, a little bit of the backstory there?
Yeah, sure. And hey, Bug, thanks for having me on today.
Sure.
So for those that you listening that don't know Unbridled, not familiar, we kind of function like a small family office ourselves. We have about 35 entities, 400 to 500 employees, about 125 million in revenue. But when we discovered IBC or wealth formula banking, it was about 10 years ago. And it was, at the time, we only had 3 companies, I think 1 commercial property. We've got a portfolio of historic properties in Colorado now. And we were introduced to the concept by a financial advisor, probably more of a traditional financial advisor, honestly, less of the kind of Velerity Wealth comprehensive planning. But this concept fascinated us of cash value life insurance, that it can work for the estate planning, the buy-sell agreements, creating the line of credit for the business. And so we tested it about 10 years ago, purchased a policy from this advisor and used it to start an adjacent opportunity. There was a marketing agency in St. Louis that we were interested in. So we took a loan we funded a policy, took a loan, used that to fund this startup and had them pay us back. And it was an interesting model in that we took 51% ownership of the new company until the loan was repaid, and we dropped down to 19%. So it created kind of a mutual incentive for them to even pay us back early. And it worked really well. And so we just started kind of rinse and repeating that model, looking for what are those businesses alongside of ours that make sense, and can we use this strategy to fund those, and then eventually using it to purchase real estate off market, cash purchase using our policy, closing in 7 days, going to a bank, cash out refinancing, replenishing our fund. And so with us being entrepreneurs and practitioners, we just had a lot of people come to us saying, "Hey, what is it that you're doing?" We obviously were growing pretty rapidly at the time, and so instead of sending them off to another advisor, another insurance agent, we decided to bring that as an offering in-house as well, knowing that we as entrepreneurs, as business owners, we found a lot of people in this kind of wealth formula banking space, insurance agents at heart. They may know how to sell product, but not really relate to us as the business owners, as the entrepreneurs, of how do you actually implement this strategy into your world. And so that was really the genesis of Unbridled Wealth. Was we wanted to be kind of the for the people by the people type situation.
So you bring up a good point, because when we talk about some of these whole life overfunded policies, which wealth formula banking, whatever you want to call them, we're focusing generally on individuals, but you're talking about using them in the context of your business or your practice, right? Can you expand a little bit on that? Because I don't think people necessarily know some of the advantages of what you can do with that.
Yeah, that's a great point, because I think the focus has been mostly on family banking. It's often called.
Yeah.
Where it's still absolutely valid. We still do a lot of that. We've got 25, 30 advisors around the country. Our focus was starting with the business owner, because that's who we were. Because with a business, it's fascinating. Even if you have individually owned policies, some of the tax benefits of the interest expense, but using it simultaneously to fund buy-sell agreements or key man insurance, the estate planning for the high net worth business owner has been really, really valuable. So like for us, we probably have 50 policies across the companies on different key executives that it may fund deferred compensation when they're later in life, or literally even funding their buyout when they pass away. So it's become not just the individual family banking, it's how can we use the same product and strategy for multiple uses.
Ryan, you have, you talk a little bit about some of the other client-specific things like disability income, overhead expenses, all that. What else goes into sort of the entire Velerity program that we should know?
Yeah, I think in terms of framing it in the context of risk management, which I know is kind of a key point for this episode, the first thing we do is, again, as part of that intake, that financial review, we develop a client risk profile. And that is a combination of factors. That's a risk capacity, which is basically objective quantitative measures like liquidity, cash flow, et cetera. Then we've got risk attitude, which a lot of people use the term risk tolerance, but it's more, fundamentally, can you stomach a higher amount of risk, or are you more conservative by nature? And then we have risk perception, which changes a lot over time, whereas risk attitude is relatively constant. So part of the risk capacity is, how much risk can you assume given your current situation? So for a lot of people, particularly in your network, Buck, very high paid physicians, dentists, people who not only they're generating the vast majority of their own income, they're their own greatest asset, but there's also a fairly physical aspect to that, right? So, if a dentist loses a finger or a hand, Jonathan and I could probably do our jobs, and maybe Zulfe pretty well, as long as we have a computer and, we're our brains working correctly. But for somebody who, if something like that happens, it doesn't kill them, but there's a lot more that can disable you. So disability insurance is a critical risk management tool. It's not, certainly there's more things beyond just insurance or disability insurance, but that's a really important one. And then an interesting twist that just recently had a conversation with one of our new clients from your network, who he understood the value of disability insurance. And I think the medical community does a pretty good job of indoctrinating people with how important that is. But what he had not heard about was business overhead expense insurance, or BOE. And that is great for business owners because you can actually get an above the line deduction to basically cover you. It's not going to replace your personal income if you have like a W-2 you pay yourself or anything, but it will cover most of, if not all of, your business overhead expense. And you're getting that tax deduction and essentially receiving
like payroll,
employees, any loans, those standard things pretty much. There's, some details that are beyond the scope of this conversation, but generally most things besides your personal income. So having that disability insurance to replace your personal income as a business owner or employee And then also having the business overhead expense insurance with that more tax efficient above the line deduction that also covers things that would not be covered by disability insurance. So it's a powerful 1-2 combo. And then of course we've got life insurance, which you've talked extensively on the show before, but that's a really important thing. I think a lot of, I actually got more of an appreciation for that as a financial planner than as an insurance agent.
Jonathan, you guys, I'm assuming, are heavily involved in the premium finance space. Is that right?
Yep.
Can you talk a little bit about, I mean, as long as we have you here, I think it's a useful time to sort of go over, maybe review the concepts there, just because I do think I happen to be, a big fan of some of these premium finance, IUL type vehicles and that kind of thing. We've called it Wealth Accelerator, whatever you want to call it, but it's always nice to get somebody's perspective on how this works and, what you've seen in practice and that kind of thing.
Yeah, it's actually a really fascinating time in the premium finance space for a couple of reasons. The increased interest rates the last couple of years, but obviously the sunsetting in 2026 with lifetime exemptions. So I think it's probably one of the most important times to talk about premium finance.
So why don't you talk about it from sort of, just assume people know nothing about it and go from there.
Okay, so if we start with the basics, it's the concept was, you have a high net worth individual and they could pay premiums into their life insurance policy, but they know they can make more money with their cash in their business or in their investments. And so instead of them paying the premiums directly, they're going to accrue interest by having a bank or a lending institution pay the premiums on their behalf, is the basic concept there. And traditionally, the premium finance is maybe the person will pay the interest each year that's accrued from borrowing those premiums, or paying a percentage, maybe it's 20, 30, 40% of the premiums themselves. I'd say the most interesting one for me, most recently, Buck, is looking at especially those, and this is where we've worked with family offices and ultra high net worth individuals, is situations where you can actually have even the interest accrue. So you have, let's say you've got a family office or individual that already used their lifetime exemption for estate planning. They don't have any more money they can put into an ILET without paying taxes into it. You can actually have a situation is for the right individual, the right family, but where even the interest is accrued for the rest of their life.
What do you mean by that? So give us an example. Explain that.
Yeah, I'll give you an example of a family we're working with right now, large net worth, $300 to $400 million. They've already used their lifetime exemption, which for those who don't know, it's about, I think it's $13.5 million per person right now. How much money can be left behind tax-free to the next generation? That's likely cutting in half approximately in a couple of years. And for that individual, if they've already pre-gifted while they're living into their exemption, so maybe they've already maxed out how much they can remove outside of their estate, they can't give any more without having a taxable event. So if they wanted to buy another life insurance policy, which is a common estate planning technique, they would have to pay taxes on the premiums. Or if they pay interest into that trust, same thing. So there's actually a strategy where 100% of premiums plus interest is paid for by a lending institution. So you don't use any of your exemption, but still have the death benefit outside of your estate. And the lending institution essentially gets paid off at time of death. So you never have a taxable event while you're living. And that net death benefit, the remainder above what is owed to the bank, is just transferred to the next generation tax-free.
Let me try to summarize this, because sometimes it gets complicated, and I tend to think very simply. So if I get it, most of my audience gets it. First of all, let's start with the limits in terms of how much the estate tax is. Most people think, well, gosh, that's 20 some million because I'm married and I don't need to worry about that. I think that's a big mistake for a lot of reasons. One is anybody who's listening to this program who's in their 40s, even 50s, making close to $1 million a year, it's going to accrue quickly. Second thing is, there's almost no doubt in my mind that those limitations are going to go down. In fact, we have a sunset coming up as it is. In general, if you think about the way the U.S. economy is right now, there is not a lot of incentive to continue to give ultra wealthy people significant breaks. So if you think, 23 million, maybe that's out of, but this could come down to the point where you're really looking at like a $5 million per person type situation. I would venture to guess that almost the majority of people listening to this program will hit that net worth limit at the time of their death. Now, I bring that up because what you're talking about here is how much can you give away basically to your heirs without that being massively taxed. And these are punitive taxes, like 50, 60% in some cases. And what you're saying is, if I'm correct, is you may run up to the limit and say you've already given a certain amount, and now you can't give any more. Now it's considered, anything above and beyond that would be taxable. But what you're saying is you could bypass that by essentially having everything, the premium, et cetera, all of that go through a loan. So effectively, you're not paying into it, so it's not taxable.
Correct. Essentially
bypassing the entire estate tax limit. Am I right about that?
100% correct. And this is, we've even had people claim that this isn't a legal practice. It is not. We've had tax attorneys review the largest banks, BNY Mellon, Bank of America, the lenders, and largest life insurance carriers in the world allowing this. Now, it's not for everybody. It functions for specifically high net worth individuals, but it's a really...
And I will say this too, is that, the old joke, I always hear about it from attorneys, is that the estate tax is the stupid tax, right? Because basically it's there, and then it will get you if you are not paying attention. If you don't know, there's generally quite a few ways of circumventing this in the law already, and this is a very creative and interesting one, and one that really doesn't cost you any money, which is great. And leave you leave your heirs a lot more money. But again, you're only going to know that if you're in a situation where you have got somebody making sure you're buttoned up. And that's exactly sort of circling back to what the whole concept of Velerity and family offices and all that is.
Yeah. And that's where I think the industry has become more of a sales industry. And the financial advising, wealth management industry, unfortunately, a lot of times it's account managers and salespeople sitting in front of families. And that's where I think groups like Velerity Wealth and Buck, you providing a platform for people like them is so valuable for higher earners, so they can skip the sales part and go straight to the education and people who really have their best interest in mind.
Yeah. Zulfe, you have anything to add?
Yeah, I think to me it's meant to be an example of the types of engagements that we have with our clients. So certainly this is representative, and Ryan and Jonathan are representative of the type of professionals that we have on our teams when we're coming up with solutions. So just wanted to make sure that everybody understood the depth and breadth of what we do at Velerity Wealth.
Yeah, and I think the takeaway here is that a lot of people probably listen to this and go, this is getting really complicated. That's the entire point. It's all very complicated. And you can simplify it as much as you want, but the reality is once you start layering on wealth and investments and all the insurance issues and obligations and liabilities, it is complicated. And it's good to have it all under one roof, have a quarterback. And it's great to have that option with Velerity. We can just wrap it up now. Again, it's VelerityWealth.com. Is that right? No?
That's right.
VelerityWealth.com. And Velerity is spelled VELERITY. It's VelerityWealth.com. And if you want to get a hold of any of these guys, start going to VelerityWealth.com. And, get yourself a plan. Feel good about it so you don't, feel like you're out, blown in the wind, hoping that you do the right thing. So thanks a lot, guys. And we'll have you on again sometime. It's good to have you, Jonathan and Ryan.
Yeah, thanks for having me. It's been a pleasure.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, Consult your own financial team before making any investment. See you next time.